A very good evening, everyone. I am Mohit Mittal from Bajaj Finance Limited and would like to welcome each one of you who have taken out time from your busy schedules to attend this another exclusive webinar on one of the most interesting topics, goal planning. Do we realize that anything we do in our day-to-day life is always goal-based? Even if you, while sleeping, you put an alarm to wake up in the morning, that is also a goal for you. That how your day is planned, and you set a goal for yourself that this is time I have to wake up in the morning. How much time you need to get ready to reach that particular destination, whether it's office, school, or college, right? When you are reaching office, you plan your day that yes, what are the tasks I have to finish. In the evening, you set a goal for yourself that these many steps or these many calories I have to burn. You often keep a check of your health also, and you set a goal for yourself whether to gain the weight, whether to reduce the weight, whether to keep diabetes on check, whether to get your BP on check, or health, another health parametrics to check. So I believe all these goals are always there in day-to-day life. But what we always miss that how we are planning our financial goals, right? While making some kind of insurance or investment decisions, whether we are considering that to be part of our financial goals or no. So as to understand the importance of financial goals and how important it is to have a goal-based planning, so as to have a disciplined approach in your investment and investment behavior and habit, that what exactly need to be done. We couldn't find any other person than Mr. Swarup Mohanty, who is the CEO and director of India's one of the renowned EMC, right? Mirae Asset Management, everyone must have heard. And with his overall experience of over 29 years, and especially 20 years plus experience in asset management services, where he is currently managing a financial group at Mirae Assets, which takes a collaborative approach in managing fully diversified investment platform. I believe there cannot be any other person better than him to make our participants understand that what is the importance of goal planning, what all things need to be kept in mind, what is the right approach so as to have a disciplined goal-based planning, and what are the benefits. Without taking much time, I will hand over to Mr. Mohanty to start sharing his thoughts to our valuable participants. Thank you so much. Over to you, Mr. Mohanty.
No, at the outset, Mohit, thank you so much for the opportunity on this brilliant topic. It's a topic which is very close to my heart. And as you rightly put it, subconsciously we run a goal in every aspect of our life. Whenever we say, ऐसा घूम के भी आ रहा हूँ घर से, we have a path in our mind, right? But when it comes to investing, more often than not, this very important part is missed out. And the advantage of having a goal is so incredible that it simplifies your investment process so methodologically, is something which one needs to understand and practice. So thank you for giving me this subject and this opportunity to speak on it. I have some slides on which I want to share my views. So I'd just like
Absolutely.
to share the presentation, and then after that I'm open to all questions, and we'll take it. Uh, 1 minute. 1 minute.
Okay.
Is it visible?
Yeah, it's quite visible. Please go ahead.
Oh, was perfect. So, as Mohit rightly said, today we are discussing goal-based investing with mutual funds. I'd probably talk more of goal-based investing and then share a little bit about mutual funds towards the end. But let's start with some basic agenda to the presentation. We'll talk about goal-based investing and its process. Most important, what is the time value of money, and how do you attain some sort of goal-based investing. I'll give one or two examples. Of course, the examples can be endless, but I picked up 2 3 examples which are very relevant from our perspective, and if there are more which needs to be discussed, I can always discuss towards the ends of the presentation. But to start, let's get some basic right. And we feel there's a common misconception that when we have, typically saving and investing is always confused. More often than not, people feel if you are saving, we are also investing. Is that correct? Is something which we'd like all of you to have a look, because saving, we feel, is what is left after your expenses are deducted from your income. Suppose your salary is a lakh of rupees, and you have expenses of 80,000 rupees. So the 20,000 rupees which is left behind is your savings. Now, when that savings is allowed to grow in a certain manner, or you put it into assets which will grow that 20,000, is when it becomes investing. Clearly, money lying in your bank is probably savings, and when it enters into a kind of an asset, it becomes a process of investing. Now, when you add a purpose to that investing, no, that is when it goes to a goal-based investing. I mean, you know why you are investing, or you are saving for a reason. Once you add a purpose to your investing, the entire ball game changes, and that's why this becomes so interesting, because clearly, to just answer one simple question, if you do not know why you are investing, you will never know where to invest. So when you add to a goal to your investing process, you go one notch higher. Let's explore that. And then typically in anybody's life, and I believe this may not be the blueprint for all of us, because everybody's life is different and everybody's life is correct, right? What I wish out of my life not necessarily be what you will wish out of your life. And you will be right in your place and I'll be right in my place. But broadly, we have these 4 or 5 sort of broad aspects of life which we cannot ignore. And then at the bottom of the pyramid are our essentials, what we need to attain some very basics, which are part of our life, which are common to most people. Very few will differ, but these are, hence they are called essentials. Then as you grow, there is a need part of your life, and slowly but surely a want part of life creeps in. And then when you add that want part of your life, some sort of lifestyle changes occur, and then everybody aspires to live a better life. And in that pursuit of better life, you start adding some lifestyle needs. Apart from lifestyle needs, slowly but surely, all of us then start looking at some which we sort of put together as our luxury aspirations. I mean, when I was young, and I come from Bhubaneswar, born to 2 teachers, so our life started with probably going around in buses and trains. And then today, when I aspire to go on a flight to a foreign destination, is probably a luxury aspiration. But going on a train is an essential need. Maybe going first AC is a lifestyle need, and then flying to a global destination in a top airline would be an aspirational need. Is aspiration is the way I put it. After all this is achieved, some people then go on to leave behind some money for the next generation, and some people nowadays believe in also philanthropy. Those are at the top of the pyramid. So broadly, if you look at these 4 buckets, you can classify most of your goals in these 4 buckets. And when you look at luxury, what is luxury for me can be a lifestyle for person who is far more affluent than me, or what is a luxury lifestyle for me can be an essential to somebody else. It depends for people. I'm not here to judge people, but each to his own. And let me tell you, everybody is right in their space as long as they're able to provide money for all this. When you take this one step forward and you look at going a little deeper into goal-based investing, what is the biggest advantage of approaching your investing through a goal-based process? Because finally, a specific goal achievement is possible with recurring deposits. Very small investments can lead you to reaching your goal. We'll talk about it a little later. But once you put a goal, you can work backwards and do how much you can sort of put to reach that space. It helps select which kind of asset class will take you to the goal. I'll give you a small example. Suppose you're looking at 11 lakhs or 15 lakhs as your goal, and you have around 10-15 lakhs lying in your bank. You don't need to invest at all. You just have to provide for inflation and your job is done. But at the end, and then if you want a crore, say in a year's time, and then you have, say, 50-60 lakhs with you, that 40 lakhs in 1 year, you have to take certain risks to achieve that 1 crore. And hence you will have to invest in vehicles which would give you those kind of returns. Now, based on your goals, your portfolio can be diversified appropriately and across various time horizons, and time frames, investment appreciation can happen. And that's the best part. If you know why you are investing, that is only when you will know where to invest. Otherwise, the journey becomes very mindless. You don't know, you become a transactional investor. More often than not, you become a return chaser. I ask everybody this question: what are you? Are you a return chaser or are you a goal chaser? Now, many often I'm told, no, no, we want to create wealth. That is why we are investing. Fine, nothing wrong with that. How much wealth? If you define how much wealth, the process can be better or the process can be scientific, and you can attain on a specific way of attaining that wealth. Many people tell us that "Apne to best return chahiye." No problem. Define that best return. Once you define what kind of returns you want, then you can form a portfolio is what I'm hinting at. So always having your end result in mind gives you the path. Without that, more often than not, you will catch asset classes and make investments which are either not needed for you or will not lead you anywhere. Is something which has been proven time and again. Then at the end of the day, achieving goals in desired time frame gives freedom to other goals. Now I want to buy a car, but I'm not having the money. Once I fix a goal that I want to buy a car in 2026 and I buy my car, that goal is attained, I can do something else. That's the best part of goal-based investing. Now, finally, goal-based investing gives you financial discipline. It gives you a path. And once you find your path, you can judge whether you're on the path or not. If you're deviated, you can do things to correct your path. It brings a certain discipline to your process of investing. It gives you the correct product selection for your goal and your time frame of the goal. You can then work backwards on what asset classes or what products can give you the desired result. Otherwise, you will be investing without knowing if that product is right for you or not. You can go on to have a risk mitigated product diversified portfolio with a aim in mind, and finally achieving a goal always leads to financial freedom. When you contrast this to just transactional investing, this is the right way of investing because it gives you a tangible process of investing and it always leads you to something which you want or desire. And that is why there has to be one process of investing, and that is a goal based process. Without goal based investing, trust me, it is a mindless process. How does the work process work? It is a very simple 6-step process, and it is very individualistic. Please understand, everybody's life is different and everybody's goals will be different. And nothing wrong with that. I cannot have the goal of, say, my colleague or say my sister or my father. Their life stages were different, their aims in life were different, my aims in life were different. Not that they are right or I'm wrong, all are right in their own places. So the first step is investing is about yourself. Investing is about knowing what you want. Investing is about what you need. Once you list them down, you can then work forward. And the first step is knowing yourself and being truthful to yourself, listing out what your requirements in life are. Then, after that, once you've listed out your financial goal, you then list out your goals as per the time horizon. Of course, you need a certain thing at every step of your life. Then you can list out in 2026, I want to do this, 2029, I want to do this, or this is very important. My son will go for his education on so and so date, and all that. Then you can build a good calendar on classifying the time horizon of each goal. Then one can then go through the next step of quantifying the future value of your goal according to the present value. Now, there's this concept which all of you would be knowing, is that inflation does creep up in everybody's life, and then there is a future value to the present. Once you know that, suppose I need 1 lakh today, what will that 1 lakh be in, say, 2030, is something which you have to then project. And as per that 2030 projection of 1 lakh, then you work backwards on creating a portfolio. Most important, and this is something which is not spoken in often, and I'd like to spend 2 minutes on this. Whenever one starts investing, one starts as a return chaser. I mean, we believe it is a process of generating returns. But as you grow as an investor, trust me when I say this, you will know that it is a process of mitigating risks. The products which are closest to your risk profile gives you the best investment experience. Hence, knowing how much risk you can take is something which is very essential to you. Again, risk profile is very personal in nature. Risk profile differs from people to people, and everybody's risk profile is correct. There is nothing wrong in anybody's risk profile. The crucial part is knowing your risk profile and building your portfolio according to it. And in life, your risk profile changes as per your life stage. What my life needed when I was 25 is very different after I got married. It completely changed after I had my son. It is very different when I'm 53 and I have 7, 8 years of work life left to my retirement. And hence my risk profile or approach to life would change with my life stage. That is point number one. Point number two is your risk profile also changes with the change in the environment. Now suppose I'm an equity investor. Now I know equity is volatile, but during COVID the market tanked 40% in just 1 year or 3 or 4 months. Do I have the appetite to digest a 40% loss on my portfolio in 3 4 months? I saw that happening, and then I have to question myself: is this right for me, or is this suitable for me? Now, certain circumstances in your investment journey also leads or affect your risk profile. So all this, adds to your risk profile, and I would really suggest there are enough tools, checking your risk profile. Why don't you do a periodic risk profile check, because they would invariably change with your stages in life. So the fourth stage and the most important part, I think, of creating a portfolio is knowing your risk profile. Because according to your risk profile, there are products. And trust me, there are products for every risk profile. The best way is to invest is to match your risk profile to that. Maybe in the beginning, you will not know, but as you start experiencing the products, you will slowly but surely know if they are suitable for you or not. My humble request is, if you think your risk profile does not match with the product you are investing in, get out of the product immediately, because sometimes the consequences will not end in a good way. And nobody wants that happening in anybody's investment life. Be very truthful to yourself. The more truthful you are, the better you will be at attaining your risk profile. And as I said, it's a journey. It keeps on changing. Just keep that in mind. After that comes something which people start as point number one. After that comes selection of products. After completing these four funds, you select which fund is suitable for you. Typically, we get asked, "There are best fund concept." And if somebody has said that this is a great fund and you should invest there, 9 out of 10 people invest there. But this is stage number 5. If you want this to become the most important part, you can make it, but you will then miss the process of investing. Please always understand that in this entire process, your most important part is your goal, not the product. The product takes you to the goal because you need the goal, you don't need the product. If you want to make me, the mutual fund, the hero, I want to be the hero. There is no problem. But I am just a means to your attainment of goal. Let's be very clear on that. Your goal is your hero. And invariably, if you have a distributor or an advisor assisting you in this process, the star being the goal, the rock star is the person who takes you to that goal. Because this looks very easy on a piece of paper, but being disciplined to your goal is a different issue. I've laid down a very simple process, and after this comes this most powerful part of the process, which keeps you on track of the goal, which is periodic review of this portfolio. A periodic review, and invariably you should put a date to that. I do it once in 3 years. You can do it once a year, once in 2 years. That's your call. But once you put a date, that date becomes important, not markets. I can give you enough data where markets are inconsequential to your overall wealth creation. This process is more important than the markets. 99% of wealth is created on this process. 1% of wealth is created on the markets. You know why 99% of financial plans fail? Because 99% of people concentrate on markets and only 1% concentrate on this part. So, this is very important to understand the process of investing. And more important, once you've made your portfolio, the periodic review gives you that ability to check your portfolio. If you are on track, well and good. If you are not on track, it gives you that power of correcting your process. We'll discuss that a little elaborately in the next few slides. Because what are the instruments available for investing which form that portfolio? Of course, there are insurance products, there are mutual funds, there are stocks which are you invest directly in the market, fixed deposits, and today, as we speak, the fixed deposit rates are looking very attractive to you. Gold remains a fantastic hedge to volatility in the market. And when I refer to gold, I talk about digital gold, which is investing gold, not the jewelry in your house. That does not qualify for investing because when you go to sell, you will know that the value that you bought it at and the value you sell it, so going to sell it, will have a fair amount of deduction. So for me, in this moment in financial investing, the gold I'm referring to you is the digital gold which you can buy and sell. There is PPF, which forms a big part of everybody's portfolio. Post office schemes also give you a fair amount of good returns, and then the returns have been coming down, but they're still there. And real estate, which forms a large part of everybody's portfolio. When we talk about real estate, please understand we don't talk about the house being real estate. The house you stay in is not your asset because you can't sell it and solve your financial problems if you are in trouble. So it does not qualify as investing. The second house or anything that gives you income or generates income in the form of rent or appreciation, whatever, that qualifies as a financial asset. Otherwise, as an asset. Otherwise, the house you stay in invariably does not qualify, right? If you are in trouble, you can't sell it. Like I said, even you can't sell a small part of your house to mitigate some of the financial need. You have to sell it totally, and if you sell the house you are in, then you are on the street. So we in financial terms do not include that in investing. Now let's look at two things, and one thing which you have to be very clear before you start investing is knowing that inflation actually creeps in into your life. When I talk about inflation, here I've talked about the economic inflation, which grows in and reduces the power of money. The other part which you have to be careful of, and that's a bigger sort of thing that creeps into your life, is your lifestyle inflation. Sometimes your lifestyle changes creep up so much, the kind of additional money that you start needing for them is pretty humongous. I'm not saying it's a wrong thing. The only thing that I want you to know is you need to be aware of the lifestyle inflation that happens in your life. Once you know that, you can plan for it. Now, here's a very simple example. 100 rupees in 1990 in India is valued at 9.5 rupees in 2023. That is how much inflation has eroded your money. That's the power of what inflation takes away. So if you had 100 rupees in 1999, what it could buy you is what you are able to buy at 9 rupee 50 paisa today. That's how money erodes. There's a very famous saying by Henry Youngman is that 20 years ago it took two people to carry $10 worth of groceries. Today a 5-year old can do it. That's how money gets eroded, and it's very important that you know this. So I was talking about future value of money. So on the reverse, if you had a lakh of rupees, you have to check in 10 years time what is the value of that 1 lakh rupees, and if you needed 1 lakh, then you have to provide for that excess. It works the other way. Now, when you look at mutual funds as a path to attaining these goals, one of the most powerful route, and I'm very happy to say that the Indians have taken to this process very well, is the systematic investment plan, which we call the SIP. Now, when you put a goal to an SIP, you can invariably, and I would really encourage all of you to use some of the financial tools that are there on the internet to work backwards as to if I want a crore of rupees in this many years, how much of SIP at what return I would need to do per month. And through this, you can go on a steady path, on a processed path to reaching your goal. The other part is, of course, a systematic transfer plan, in that you put some money in a safe asset, say a debt side or a safer asset, and systematically transfer it into a growth asset to reach your goal. Once you reach your goal, the best way is to put it in a systematic withdrawal plan. Say, I'm planning for my retirement. After I achieve my retirement, then I work on converting my active income into a passive income. And from my passive income, the best way to take out is through a systematic withdrawal plan, which the industry proper. The least talked about, a very little talked about part of investing is the SIP top up plan. And I'd like to talk about it because it is extremely powerful in your approach to goal achievement. And I'll speak about it in the last two slides. And the other part, of course, when you have lump sum money you invest, invariably people ask us which is the best time to invest. We say when you have the money you invest. Otherwise, you are timing the market. And most of us know that timing the market is futile. So these are certain facilities which are provided by mutual funds through which you can go on to reach your goals. Let me give you a small example of what happens. And then this is one of my favorite examples, and I do work on this example is, suppose I take a home loan, and let's just assume that the home loan is a crore of rupees, and the rate of interest is 8.5% for 30 years. So the EMI will be around 76,000 odd rupees, out of which in 30 years I will totally pay the home loan company some 2 crore 76 lakhs, out of which 1 crore 76 lakh is my interest component and my principal is 1 crore. In 30 years, on a 1 crore loan at 8.5%, I actually pay 1.76 crores as interest. And we have to do that because we can afford an EMI and I can only afford 76,000. So I take this route. Now, how can we help you, or the investing process help you in this process? We say you take 10% of your EMI. Say in this case 76,000, invest 7,600 rupees in the form of an SIP in the equity markets. And I've given you an example on this investment in the Nifty 50, which is thus the broad index of the Indian market. And in the last same 30 years, your 7,000, this is an illustration. You can work backwards on the other parts also. But the point I'm making, if I took 10% of my EMI amount and parked it on equity, this 30 years, I would be able to gain my interest component out of that SIP just by 10%. So actually, in that process, I would have gained my interest process completely back. In fact, the actual figure is more than 1 crore 76. It's actually 2 crore 35, and left with 58 lakhs more. But this is an illustration. Typically, it may not behave like this. But the simple point is, if you were to put 10% of your EMI into a growth fund, you could actually end up covering your interest component in the goal period. It helps you brilliantly if you use your investment process in a simple manner. The other one, which is very important, is your top up. Now, invariably, when we do an SIP, we do an SIP for life, or we call it perpetual or whatever. But here are two examples. I start one SIP in, say, 2003, and I want 1 crore. At a 12% CAGR, I will get to 1 crore in 23 years. I mean, 2003 to 2023, in 20 years it takes me if I do a simple SIP. Now, if I convert that SIP to a 10% top up, that is, if I start the first year at 10,000 and I gear it up by 1,000, the next year, and next year it becomes 11,000, so I add 1,100, a 10% top up, then the same 1 crore I achieve in 17 years. I gain 3 years by just topping up the SIP by 10%. The top up SIP, I would say, is a great way of achieving your goals in a quicker manner. And you can always regulate this. If you're not, then you can probably add another 20%. Hence, all your SIPs should be also part of that review plan. And if you're on the path, fine. If you want to increase it a bit, or get your goals a little ahead, or you've started earning a little bit more, you can always top up your SIP to reach your goals faster. I'll give you a small maths. a 35,000 rupees SIP. I repeat, a 35,000 rupees SIP with a top up of 10% in an investment which will yield you 10%, will you give you a crore in 10 years? That's the maths. 35,000 top up 10%, yielding 10% gives you 1 crore in 10 years. So that's how, mathematically you can reach a goal if you know how to do it. And top up is probably one of the most powerful, yet the most undermined process of investing in India. The last slide which I leave, and this is one of my favorite slides, is that why is goal important and why remaining disciplined on the goal is most important. Typically today, when retirement is probably one of the biggest reasons one should invest, because it's the biggest ticking bomb of India. Hardly 10% of investing of working population have pension. So when you start creating a pension for yourself, there is this study where we're basing this on the study, is that typically in any decent city in India, you will need to have 3 crores to lead a sustainable life on your just the need part if you retire per person per family. That is what that study said. So we are basing it on that. Now our view is if you do 10 lakh investing and invest for a period of, say, you start at 99 and you want 3 crores, you will need 10 lakhs to be invested at 12%. So 10 lakhs lump sum invested at 12% will give you 3 crores in 2023 if you had invested in July 99, right? Now, all it needed was to put that 10 lakhs and stay invested. What happens if you start taking out a little bit of that money is something which is very staggering. Now, if you took out, say, 70,000 for a phone from that 10 lakh that you invested, you would actually go down by 15 lakhs of your overall portfolio in that same period. The 70,000 withdrawal from your phone after the 1 year would have lost you 15 lakhs of that 3 crores. Now, if you withdrew, say, you took out some 3 lakhs for a vacation, that would lead you to lose 50 lakhs, almost 49 lakhs out of that portfolio. And if you took out 10 lakh for an emergency, medical emergency, you would lose nearly a crore of that. So while there is this powerful route of compounding, if you take out money, your compounding process also goes out. And there is this reverse compounding which happens, and that compounding amount is fairly large. What looked at a withdrawal of 70,000 today is actually an impact of 15 lakhs on your overall portfolio. So the simple submission I'd like to leave behind before I end my session is when you put a goal, the investment you make should be kept throughout for that goal. Don't tinker with that investment or don't take out money from that path of that investment. It leads to pretty negative returns, and one should be careful of that. The simple point I wanted to make are two. One, without goal, don't invest, otherwise, it becomes a mindless process. Second, once you plan your investment process, stick to that, and then achieving goals is feasible. If you do a periodic review, you will know whether you are on the path to the goal. If you are not, you can correct it through the help of your planner. So I wish you happy investing, and I really wish all of you reach your goals in life and make your investment tangible. And that's what investing should be, to enhance your life, not to complicate your life. Thank you so much for your patient hearing. And if there are any questions, I'm really,
Sure.
really.
Thank you so much, Mr. Monty. Thank you. I believe I already had a list of questions, but couple of questions related to that. What should be the ideal goal setting process, and how a person should start deciding that whatever investment they are making, how should they link it with the goal, is well answered in 6 7 steps you have mentioned, where you have clearly given a very clear guideline that first decide your goal, then you can give a quantify value to that particular goal, decide the tenure, accordingly assess the risk, which is highly critical. Until unless you analyze your risk, you cannot estimate the kind of asset class you should choose, right? I have seen so many people um, with whom I have interacted, and they ask that I want a return of 15 to 18%, right, or more than 12%. When I ask them to complete their risk profile form on our app, we could find that they are highly conservative or conservative customers.
True.
So we told them that it is a very clear, indicative, and transparent uh, metric within all the mutual fund schemes per se, that
True.
every scheme carries a risk profile. So it's better to choose the funds as per their own risk appetite and profile, and not only the funds but the overall asset class. And as you
True.
rightly said, the closer you are along in your investments with your risk profile, better it would be in the long run. So rightly said, I think very valuable input, Mr. Monty. One question I just have related to the same: when you say that gold tenure should be decided, how much is the ideal tenure you see when in terms of, I believe every goal has different tenure, that is true, right? But for a first time investor who just want to start some investments keeping in mind to have a wealth creation, so how much time you should say should be a disciplined approach while expecting some decent returns in equity?
See, again, as you rightly said, every asset class has its own tenure.
Yeah,
Say when we look at bank FDs, the tenures are laid down. So
yeah,
suppose we look at an FD of Bajaj Finserv, it's laid down. So you know what
yeah,
is you are getting at a certain period of time. But when you come to the capital markets invariably is about investing in a business and getting the returns of that business. And the business, all of us know, takes time. Our objective should be to invest in good, strong businesses and take the journey of the investment. Now, suppose I were to flip it to you and ask you, if I were to ask, is this the best time to buy, or is this the right stock price for Bajaj Finserv? I don't think Mr. Bajaj would be able to answer that question.
exactly,
Our job
exactly,
is to assess that Mr. Bajaj is the right person to run this business, which he is. Obviously, that's why it's such a successful business. And take a journey with Mr. Bajaj. In that process, he will unfold his business wealth to the shareholder. That is what is
true,
participating in the equity market is. And
absolutely,
invariably, we say, typically this figure used to be 5 years, but now we've changed it to 7 years, because when you look at investing in equity markets, mathematically 7 year investing has not given negative returns in the broad market, that is the Nifty 50 or the larger companies.
absolutely.
So I would say the minimum starting point should be 5 to 7 years. Is a good way to give your investments some leeway for it to start yielding good returns for you.
True, true. I believe such kind of observations and experience teach a lot to the customer
True.
because there are so many mathematical formulas while calculating the returns, while calculating the amount of investment to be made, which completely depends on the risk profile and the asset class customer choose. But the approach that yes, one need to be a disciplined investor while deciding the goals and putting your investments in place along with that particular goal. I think discipline is something I would always appreciate. And I remember a very famous quote uh, where it is mentioned that invest and forget. So I believe this famous quote from a world's most interesting person in investing, he has quoted sometime. So that also shows that yes, if you continue checking your bank balance or mutual fund portfolio on daily basis, it will not make any difference to you, right? Difference
Yeah,
you will see, of course, when you see it on a particular time frame. And as Mohanty has also rightly mentioned, that as we do our health checkup, right, we need to have our financial checkup also in place,
true. Most
right?
important.
And
Now,
yeah,
just
when
to
we
tell you,
say
Mohit, I firmly believe the person who has built the maximum wealth in mutual fund is the person who has lost his or her account statement.
absolutely,
The,
absolutely.
the person
And
who
in
does
fact,
not
I
check
would
makes.
in fact, in terms of financial health, now I have seen people check it on daily basis or maybe alternate day basis, right? But that is just seeing the same report card every time or the lab test which you must have conducted 6 months back, right?
Correct.
So
Correct.
true
Absolutely.
financial
Well said.
health checkup means that you need to get in touch with the expert or you have to evaluate yourself considering the market scenarios, that what asset classes are performing, whether your account portfolio is rightly diversified or no. and accordingly same decisions can be taken so as to have a better output. Great, great. One last question, Mr. Mohanty. SIP or lump sum in this particular scenario, right? When markets are all-time high, what kind of approach one should have while setting the goals? So, any suggestions for the viewers and participants that what should be the right approach here?
Mohit, please bear with me when I say what I am going to say now. See,
Okay.
typically from an investment perspective, no, the SIP is typically a cash flow solution. I don't have money, a lot of money, but I'm a salaried person. I have this much of cash flow per month, and I have this much I can spare. It is something like a recurring deposit which used to happen earlier. So an SIP is a cash flow solution.
Yeah.
Itna I will participate every month. So it is a cash flow solution to investing, nothing more. Now,
Right.
if the moment you convert your lump sum to SIPs, in whichever justification I might give, I'm actually starting to time the market. That is the
Absolutely.
reality.
Yeah.
See, whenever, and I said this, whenever somebody asks us which is the best time to invest, we say when you have the money.
Yeah. It is always the right time.
Yeah, because see, it's a no-brainer. India
Yes.
went from 1 trillion to 3 trillion. You
True.
1 lakh when this 19 years ago or 20 years ago is worth 19 lakhs in the market now.
Yeah.
We are at the same stage. Your 3 trillion is headed to become 6.5 trillion in the
Yes.
next 8 to 10 years,
Yeah.
right?
Yeah.
जो बैठेगा बाजार में वही कमाएगा,
True.
right?
True.
Now, if you look at a 6 trillion economy, what is market high today? See, the NAV is not going to stop if you redeem. Let's be very clear on that because
Yes.
this economy is going from 3 to 6 trillion, right?
Right.
Companies will only grow at 6 trillion. The sizes of these companies will be substantially different to what it is now. So,
Right.
for people, and here's where I make the demarcation for people who invest directly in stocks, they can get into this debate ki how much lump sum, itna lagao, nahi lagao, that's a separate issue. But when you come to a mutual fund, you're actually hiring a fund manager to do that on your behalf,
Absolutely.
right? So don't confuse your lump sum with SIPs. Have the conviction, and that's where your risk profile is very important. Technically, when you are hiring a fund manager and you are paying a fee, let this be the fund manager's botheration, not yours.
True, 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 true. In fact, Mr. Mondi, you have very rightly said, and a different perspective you have shown to the viewers that I also experience when I meet people. There are few customers who ask me whether I should invest in mutual fund or SIP, right? Then
Correct.
I
Correct.
have
Correct.
to tell them that SIP is nothing different, but it's just a way to invest, right?
Yeah.
If you want
Mohit, just
to,
to, I sorry,
yeah,
I just I'll butt in. As a fund house, now we are fully invested.
yeah,
We believe asset allocation that happens at your end and your investors' end. When you give us money,
right,
we will buy. We don't take a cash
exactly,
call that, this is today,
exactly,
we'll stagger it. We don't. And if you look at
yes,
our 15-year track record, it is there for you. We are lump sum investors, actually, if you
yeah,
put it in perspective. When we get
absolutely.
the money, we buy.
True, true. For AMC, you are rightly said that it doesn't matter whether money is flowing through SIP or lump sum because you whatever money you are getting, you are investing again back into the market. From the customer point of view, of course, there can be different segment of customers. There are senior citizens who are having lump sum amount of money, or maybe people in the younger age also who have lump sum money with them. They don't want a monthly cash flow, but there are segment where employees are there. They want to have a regular cash flow and they are interested more in investing on a regular basis.
True, true.
So SIP and lump sum is just a mode of investment in mutual funds.
Absolutely.
It's not the different type of mutual fund, or it
True, true.
doesn't make any much difference. So I think viewers,
Absolutely. Very,
you
very
have
well
to
put.
choose. Yeah, and there is no right time to time the market, right? No one can time the market. It is always, if you have money, invest now. When Mr. Monti has already mentioned, 7 years should be the minimum ideal time to be in the market. So, as for the past experience and the future prospects of the industry and the company, you can easily take out the decision that yes, this much time one should have, and this much of returns or the asset classes you can choose for us to have investment in the long term phases. Great, great. One last question, Mr. Mohanty. What is the favorite sector you will suggest to the customers in this scenario? if I would say, uh,
Sector
consider
today.
most. So this is a very common question we receive from people, that what kind of sectors. And I specifically mentioned that we are not talking about sectoral funds here, but yes,
No, no,
when it comes,
I have no problems. See, if you look
great,
at a
great,
secular sector
yeah,
for the next 10, 15 years, my personal favorite still remains consumption. India is a consumer country. Okay, so
right,
the consumption is like an evergreen 15-year secular sector or
okay,
theme, right? But if you look at it from the present perspective, I will stick my neck out on IT, which is a core
okay,
sector or theme which will back every business, and it is available at a very attractive price at this moment.
right, okay, great. I think
I would
everyone
do a
knows why.
I would do a 12-month SIP in an IT fund if I were to give you
Oh,
my view.
great, great. I believe the statements, most of the statements which we are seeing, and we also believe that yes, this decade is India's decade,
True.
and of course, through digital and the kind of consumption we have, and also the production, I believe this statement holds true and give much confidence to our viewers that yes, what is the right sector to explore, and then there are different categories within the mutual fund schemes which investor can choose depending their own risk profile and the time horizon, and of course that can be taken care of in a better
Just a
way. So
disclaimer: I don't have an IT fund. Huh? Just a disclaimer.
yeah, yeah. Absolutely, we understand. Okay, I'm done with my question, Mr. Monty. Anything specific you want to mention about the customer philosophy or the
See,
Mirae AMC as per se, that what kind of investment philosophy the AMC is following in the interest of people, which can be helpful for people to take some decision about their own investments.
Mohit, thank you for saying that. See, we are a very simple fund house and we'd like to keep things extremely simple. People invest in mutual funds for diversification. So, our process of investing has been extremely diversified. We don't take concentrated stock calls. And at times, like the market in the last 2 years, where some concentrated stock calls have yielded very high results, probably our investment style is a little more diversified than the last 2 years. But that does not mean we will deviate from our investment philosophy, and that is the discipline that is required, or that is the discipline that we talked about in the last 1 year. That is our style. We will stick to that style, and invariably, that is the style which has given us results, and we are very confident of that. Every fund has its own mandate, and trust me, when you track our funds, we are true to mandate in all our funds. So it's been a 15-year track record. We manage around 1,20,000 crores of equity. So very, very happy and satisfied with the process so far. But from here on, with our size, I think we've built a good platform for businesses going forward.
Certainly,
And very confident of the Indian stock market because of the underlying fact that it's a no-brainer, 3 trillion going to 6.5 trillion in the next 8 to 10 years. And make no mistake, irrespective of any kind of intervention, this journey is there, right. So
certainly,
more than knowing this journey, as investors we have to internalize this journey, that this is
yeah,
happening. And the best way for people to benefit from this journey of India is through the capital markets. Participate in the capital markets. I'll end by saying that there is a risk to investing, there is a risk to not investing as well. There is
yes,
a risk to
absolutely. That's a
investing
much
in
higher
equity.
risk, I believe.
There is a risk to investing in equity. There is a risk to not investing in equity as well. At this moment, the risk to not investing is substantially higher.
Absolutely, absolutely. I believe that's why we try to conduct such kind of webinars so as to get some good answers from the industry experts for our viewers, which helps them to take some right decisions about their own investment portfolio and clearing their doubts in kind of volatile market or whatever other kind of risk appetite or the returns kind of questions customer comes. So I believe viewers, through this kind of webinar you must have understood the right approach of investing, having a disciplined approach, a good investment horizon one should look at, the kind of diversification and its importance, what should be the risk profile appetite, and how you should choose the right fund for your own portfolio. I believe all these answers you must have got from this particular webinar. And we again thanks Mirae Asset Management and Mr. Swarup Mohanty, who shared his valuable thoughts. And I am always fond of his views. And I thanks for this opportunity. This is the first webinar with Mirae Asset, and we got Mr. Mohanty here. And we'll love to invite him more often on different topics. And our viewers will also be very happy and delighted to hear you, Mr. Mohanty. And thank you all viewers who have taken out time on this Friday evening so as to get some valuable decision about your own financial health overall. So thank you so much. Thank you, everyone, and thank you the moderators
Thank
who
you.
have helped us to manage this particular webinar. Thank you. Namaskar.
Thanks. Thank you so much.
Thank you.